whole life insurance is either the most elegant financial tool you've never fully understood, or the most misunderstood product sitting quietly in millions of American households right now. We're gonna crack it open today, run it through 30 years of real-world pressure, and show you exactly what survives. Here's the uncomfortable truth most agents won't walk you through. When you start pulling loans and partial surrenders from a whole life policy over decades, the death benefit your heirs receive looks very different from that glossy illustration you signed. The gap between what was promised and what gets delivered isn't fraud, it's math, and we need to talk about it. Let's set the stage with a real example. Imagine a 45-year-old takes out a whole life policy with a death benefit of $500,000 and a starting annual premium of around $8,000. By year 10, their cash value has grown to roughly $90,000. Dividends are being credited, and everything looks like a beautifully compounding machine. Then life happens. A business opportunity, a kid's tuition, a rental property, down payment, and in year 11, they take their first policy loan of $30,000. Here's what most people don't realize. That loan doesn't disappear. It accrues interest, typically between 5 and 8% annually, quietly compounding against your own asset. Think of it like borrowing from a river to water your garden. The river keeps flowing, but you've redirected a stream. And if you never fully redirect it back, the downstream gets thinner year by year. By year 15, between accumulated loan interest and a second partial surrender of $20,000, the outstanding loan balance has climbed to nearly $65,000. Now here's where the behavioral economics get fascinating. Most policyholders in this situation feel fine because the cash value statement still shows a large number, but the death benefit, which started at $500,000, has been quietly reduced because unpaid loans are deducted directly from the death benefit at the time of death, dollar for dollar. Historically, whole life policies have survived market crashes, recessions, and interest rate chaos in ways that pure investment accounts haven't, and that stability is genuinely impressive. But the persistence of the myth that the policy pays itself has led generations of policyholders to treat loans like free money, which is the financial equivalent of believing calories don't count if you eat standing up. Let's fast forward to year 20. Cumulative loans and surrenders now total $110,000. Loan interest has added another $40,000 on top, and the net outstanding balance against the policy sits at roughly $150,000. Your heirs, when the dust settles, receive approximately $350,000 instead of the original $500,000, a difference of $150,000 that nobody planned for. The common misconception here is that dividends will save the policy. And yes, participating whole life dividends can partially offset loan interest, but only if the policy was designed for that and the dividend scale holds. In a lower than illustrated dividend environment, which has happened persistently since the 1990s when interest rates dropped, that buffer is thinner than the brochure suggested. So what's the actionable lesson? First, any loan strategy on whole life should be built into the original illustration. Ask your agent to model a 30-year loan scenario before you sign anything, not after. Second, treat policy loans with the same discipline you treat any other debt. Either service the interest annually or plan explicitly for a reduced death benefit and communicate that to your heirs so nobody is surprised. The philosophical truth underneath all of this is that whole life insurance is not an either-or product. It's a long game, multi-purpose vehicle that rewards discipline and punishes improvisation. If you go in knowing you'll take $200,000 in loans over 30 years and you've modeled the residual death benefit at $280,000, that's not a failure, that's a plan. And here's the quiet comfort in all of this. The policy, if funded properly and managed without catastrophic overborrowing, won't implode on you. It won't lapse unless the loan balance exceeds the cash value. And a good advisor will flag that threshold years in advance. The beauty isn't in the perfection of the outcome. It's in the predictability of the guardrails. Whole life isn't for everyone. And it's definitely not a get-rich-quick scheme wrapped in legal language. It's a slow, deliberate, generationally minded tool that works best when you respect its mechanics. Discipline, sizing your loans correctly, and consistency in premium payments are what separate the people whose heirs celebrate from the people whose heirs are confused at the attorney's office. Whatever your outcome ends up looking like a full $500,000 payout or a reduced $300,000. After decades of strategic borrowing, the families that win are the ones who planned for both possibilities and stayed emotionally detached from the number on the illustration. Rational preparation beats hopeful projection every single time. And if any of this has you thinking about how whole life fits into a broader wealth building strategy, whether that's real estate investing, funding a renovation project, or finding the right lending structure, check out our links in the description below because we can help you get started.